What's going on, Investomaniacs? Boy, Knight Rider here, and today we're going to be talking about SFIX. SFIX is a unique service which provides personal styling to their clients. Basically, you sign up, you answer some questions, provide some information about yourself, some aesthetics you like, say via platforms like Pinterest, and then SFIX personalized stylists will send you clothing that fits your style. I did try to sign up for this service, but when I sent in a picture of myself, they replied with, "Mr. Knight Rider, unfortunately, it's impossible to make you any better looking than you already are." I'm okay, I guess that's a good enough reason. You know, like Cardi B. Okay. It's obviously a relatively experimental service. Nothing has really been tried like this personalized shopping on this scale. This has the potential to be a big game changer, but it also has the potential to stay niche. The company has only been public for 2 years, and we can get some idea as to how things are going by looking at their rate of customer growth. For a company at this stage of their life, I like to look at customer growth as my preferred metric, right? Customer growth over revenue growth. Using customer growth as a metric, it hasn't been the best year for SFIX. Year over year, client growth has decelerated 32% in its most recent quarter compared to 2018 growth, and that has decelerated 45% since 2017, despite its advertising budget actually increasing as a percentage of revenue. That rate of deceleration would indicate SFIX may be more of a niche concept compared to something which can scale to the masses. The slowing rate of growth has understandably inspired some pessimism in analysts as to how popular personalized shopping could ultimately become. That being said, SFIX itself obviously remains optimistic and wedded to the narrative behind their own brand. CEO Katrina Lake recently outlined the core belief of SFIX's appeal, that it provides an antidote to the overabundance of options provided by typical e-commerce. It is a valid point to an extent. Too many choices can be a genuine problem with other e-commerce companies like Etsy, which we do like, by the way, and they are trying to attempt to tackle that overabundance of problems with similar personalized services and search results. However, I would say from a sales standpoint, I don't think this is the best way to proclaim your differentiation from standard e-commerce. I think that this overabundance of choices, if standard retailers like standard really clothing retailers and people like Amazon think that this is too much of an issue, they can just change their search results to be a little bit more narrow. I really don't think people need personalized shoppers to accomplish this for them. So I don't know, if that's what you think your differentiating thing is, then I kind of don't buy into that, and it makes me a little bit less of a fan of the service. It should also be noted that while the growth rate has slowed, the company is still growing relatively quickly, right? Revenue is up 26% year over year, and active customers are still up 17% year over year this most recent quarter. SFIX has also recently purchased a distribution center in Georgia, which will allow them to continue to expand their employee base by about another 1,000 people. So they are confident in their own company, and I do like that. I like distribution centers. I've always said that. I'm a big fan of distribution centers because they require a lot of capital. It's a big investment, and you need to be really confident in your business to do a distribution center. Now, let's take a look at a couple of the details from the most recent quarter. They've got 100 data scientists. These are people kind of creating the algorithms to recommend styles. And then they have 3,900 plus personal stylists who are hand picking the styles to send to you. The company was started in 2011. They have 3.1 million active clients. 63% match score, meaning of the things that they're sending to people, 63% actually end up buying, but that means that they also have a pretty darn large return rate. And so this is our active clients. As I stated previously, 17% growth the most recent quarter on a year over year. That's down from 25% year over year growth in 2018, which is again down from 31% growth in 2017. This is despite advertising as a percentage of revenue actually going up. So that's, it's one thing if their advertising isn't going up as a or decreasing rather as a percentage of revenue, but when we have advertising as a percentage of revenue actually increasing, and then we're still seeing such a sharp deceleration of kind of new clients coming on, that is concerning. Our revenue is up 26% in past 9 months and 2018. That's down from 34% top line growth in 2017. Let's see here. We have advertising expenses as a percentage of revenue was 3% in 2016. That jumped all the way up to 7% in 2018 and further increasing to 8% in 2018. And then we have here, at the same time, we continue to drive engagement with our existing client base, growing revenue per active client 8% year over year. So that's how we're coming to 29% growth, even though the customer base is only increasing 17%. They are increasing their kind of existing active client base by 8% up on revenue. So that is pretty decent. Operating margins are going the wrong way, however. So in 2016, they were doing quite well with 8.8% operating margins. That decreased all the way to 3.2% in 2017, 3.5% in 2018, and then in the last kind of just couple quarters, it's gotten pretty bad, and so now our trailing 12-month is down to 2%. The reason why, now you may say, oh, but they're a profitable company and they're still growing the top line at 29%, so shouldn't we be more lax with them for having a decreasing operating margin when a lot of people growing their company at this rate are losing money? And yes, that's completely true, but it comes from a relative standpoint. So if we were growing at a given rate at 8.8% and then 3.2%, and now we're down to 2%, sooner or later we're going to have to stop shrinking that operating margin, and when we do, that's when the growth is then going to contract quite a bit. And typically speaking, once a company turns profitable and starts trading off its PE, it's like it doesn't really go backwards. It's really difficult, and the stock is not going to perform well if a company starts losing money again. So to some extent, these guys don't really have an option, at least if they want their stock to go up or not plummet. They don't really have so much of an option to go back to being unprofitable. They need to take care of their operating margin, which means they don't have too much more room for the operating margin to go down, which means, again, they're not going to be able to grow the top line as much when they don't have that room on the operating margin. The PE is now at 62.4, which is decent for a company with this growth rate. So that's why Stitch Fix is in a little bit of a difficult situation for how I feel about it. Looking at the most recent quarter, I like the numbers, I like the valuation. However, when user growth deceleration is taken into account in conjunction with the margin contraction and a higher percentage of revenue being spent on advertising, you kind of take those things combined, and it does make me concerned, even though the kind of like super macro top line numbers, the kind of super headline numbers still kind of look pretty decent. When you go a little bit more in depth, I'm going, I can see this top line is probably going to start contracting relatively soon, or the bottom line is not going to do well, and because it is now a profitable company and it is trading largely off the PE, that's not going to be good for the stock price, even if they can continue to get the top line to grow decently. Plus, on a personal level, I prefer to invest in companies I think have the potential to become quite large. On a gut level, I am not convinced this personalized shopping concept can scale. But I openly admit I could be wrong on that. I don't know. I'm just not convinced, like the way I am with some of these stocks that I own, like Etsy and Roku and Shopify and stuff. Like, I'm like, I know these things are going to scale, particularly stuff like Shopify and Roku. Like, that's like, I mean, those are the ones I'm most convinced in, like, these are going to scale. Whereas with the personalized shopping, I'm like, is it just a niche and we're just growing into the capacity of the niche, or is this something that can actually go broad? My gut instinct says it's more like we're growing into the capacity of the niche. But again, I was kind of raised like a poor person, so I don't always, sometimes it's difficult for me to understand certain concepts that don't really relate well to people who don't have a whole lot of money. So if you believe the concept can scale and you like the company Stitch Fix, I will bless Stitch Fix from a valuation standpoint as long as you're considering it a spec. But for the time being, I personally will be sitting on the sidelines. Hey guys, that's it for this video. I put my portfolio up for full disclosure. Let me know what your thoughts are, or if there are any other stocks you'd like me to check out. I appreciate all the likes and comments. Thank you so much. And make sure you are subscribed to Investomania, brother.